Welcome to the 3 Degrees of Freedom podcast, where we explore lifestyle engineering with our expert guests to bring you in alignment with your own 3 degrees of freedom, location, time, and financial independence. All right, everyone. Welcome back to the 3 Degrees of Freedom podcast. Today, I am joined by Mr. Ryan Tansem. How you doing, Ryan?
What's up, Derek? How are you, man?
Hey, dude, it's good to see you on the podcast today, and I'm glad that you're joining us. For those who don't know Ryan, he is a seasoned entrepreneur who has mastered the art of understanding complex financial concepts and transitioning them into clear, actionable insights for investors and business owners and so on and so forth. Starting as an executive VP in his family business, Ryan orchestrated a remarkable turnaround, strategically positioning it for an 8-figure sale in 2014. Today, he's the driving force behind Aona, creator of the Intentional Growth Framework. And through educational training and his fractional CFO services, Ryan empowers business owners to view and operate their companies as financial assets, making their entrepreneurial journey truly rewarding. And he has a superpower of simplifying intricate financial matters. And he's personally guided hundreds of entrepreneurs with it. And he's the host of the acclaimed Intentional Growth podcast. And stay tuned to learn how Ryan helps entrepreneurs navigate financial freedom while making a meaningful impact. So Ryan, awesome to have you on the show, man. The first thing that we always like to start with is the basics. You know, this is a show about the 3 degrees of freedom, which is location, time, and financial. So please, can you give us a little bit of a feeling for where you are in those 3 degrees of freedom, and which is the strongest and which one do you want to pursue further?
So I'm physically in my basement out of my house that's located on the east side of the Twin Cities of Minnesota. And I have got my freedom there since COVID, actually, because we fully run remote and now we're a digital company. So my freedom of location was, truly, Derek, completely inversed, like my old situation to now. So I've got my location, my time. I've very much architected and designed the business to accommodate my lifestyle that I want over time. And then the financials, I look at the financials in 2 aspects. One is cash flow financial aspect, and then the other one is wealth creation on the equity side of assets. So the one that needs help right now, and it's on purpose, it's intentional, no pun intended, is I've been burning cash investing into my company, Aona. So it's been a cash suck because we're investing in it, but there's equity growth happening. So I'm watching the wealth grow, but the cash flow distributions could kick in sometime pretty soon after our high growth. So I would say the focal point will be the financial cash flow perspective over the next handful of years.
That's well said. I can relate personally with this because the real estate business, what we like to call it is we're reinvesting in our business, right? We're taking our flow, putting it right back in to make sure we're preserving the equity for our investors and for us.
Oh, Derek, my favorite comment is what I had a client go, Ryan, I just really don't want this to be another reinvestment year. It's like, amen.
That's so great, man. I love it. I love it. All right, dude. So let's talk a little bit about this superpower of yours to demystify complex financial topics. It's impressive skill. And I want to ask you, how did you develop it? And why do you think it's essential for entrepreneurs who are looking for independence to understand this or to seek help?
Super cool question. I would say don't learn it the way that I learned it, first of all. So how I got to simplifying finance for business owners is because I went to school for liberal arts, which was essentially, I didn't know what I wanted to do. I was a salesperson working for the family business. And so how I got into this, Derek, until people maybe better understand me, I got a D in accounting, and I literally D in accounting, I was a copier sales rep. And now I teach finance to bankers, accountants, business owners. And how I got here was after I jumped into the family business, we were doing 20 million in revenue. My dad and I are sitting there. He was very distant from the company, Derek, for like 6 years. So there was enough cash flow in the company to hide a lot of sins. And 2009 happened. It turned our business upside down, just like the real estate market and everything at that time period. And what happened was, Derek, we lost it. I was sitting in the bank in the CPA meeting with my dad in 2009. We lost $950,000 that year on 21 million in revenue. So you need cash to pay payroll, pay your taxes, and keep the machine going. And it doesn't matter whether you like accounting or don't like accounting or like finance or don't finance. Like, you have to have the money in the checking account Thursday night to wire it for payroll, to pay payroll. You can never miss it. And so you're forced to do that. And for us, we were selling copiers and then servicing them. If I can't afford the text payroll or the new equipment or the new consumables, then I can't service it. So like we needed to wake up, sell stuff and sell copiers and office equipment and service them. And what happened was my lack of understanding of finance and accounting gave me no visibility, Derek, into the future, which and whether you're in real estate or in business, you're an investor of an asset. And the way I like to think about like whether you understand finance or not, if you and I bought something, Derek, so right now it's August of 2023. And if we were to look a year from now and say August of 2024, what will our cash position be in that investment while prepaying our taxes, while knowing we have enough money to fund the growth that's tied to a valuation target, and we can take the distributions that we want? If I can't have that visibility into the future, why am I doing this? Right. And like, I was that kid in school, like, why? And everybody just says, because. If you want to send me on a decade-long journey of answering a question, so the whole framework you asked about was me answering, how come no one can give me a real answer about what my cash position will be a year from now? And everyone's like, well, we're just guessing. I'm like, well, there's got to be a better answer to that. And so I kind of went from the ops route and the goal down to the debits and credits because no one could answer my questions.
Got it. So this leads me into my next question then. Well, actually, I want you to give us a quick overview of the intentional growth framework, because, and when you do that, maybe you can come at it from an angle of how your experiences shaped your perspective on viewing and running a company to help build this framework. Because I assume you must have built it after your own experiences with your own businesses, or maybe talking with some other people. So give us a little bit of insight to the framework, and then also how your own experience helped build the framework.
Love it, dude. Okay, so I'm going to start with, yeah, and you're right. It was developed over a decade almost of people looking at me like I was an idiot, me not start like being able to like, be like, there were 6 principles, and Derek would look at me like, that doesn't make any sense. Like, well, now there's 5 principles. So it was all of the, like, so it was over like thousands of meetings. I mean, hundreds of keynotes and all this refinement. So the market really created it. I did not come from the mountain and say like, well, there's, 5 principles. What happened was, Derek, is how it got like, what is the concept? And here's what I was trying to get at. And I'm going to do a little bit of role playing right now, because this is what I do with my keynotes. And I just love it. And I started doing this 12 months ago. So before I explain what intentional growth is, what I do is I pull up this cabin that's like, it's like a $4 million cabin on like Lake Tahoe. And I'm like, before I give my story, who thinks I should buy this cabin? And I get the audience going like, yeah, go for it. And then I go, wait, I forgot a little bit of context, Derek. I got twin daughters that are turning 7. I'm going into 15 years of sports. I'm not going to have any time to attend the cabin. Would that impact your advice for me? And the people are like, maybe, yeah, still do it. And I'm like, well, what if I were to tell you it would derail our retirement plan if I bought that cabin? And then the couple of people are like, still do it. And then I said, well, if my wife threatened to divorce me because she doesn't want 2 buildings with 2 HVAC systems. Context is so important for our decision-making, Derek, that like, so what happened was for 10 years, people would call me up and they would want advice. And I'm like, what are we trying to solve for? And that it took me that long to figure out that people didn't have a goal that made any sense, Derek. So then they'd be like, 20 million in revenue, 5 million in revenue, 50 million. Like, go pick up the Inc. magazine and it's all revenue or how much people raised. And then I think to myself, my dad and I owned a $20 million business that had 115 employees. We lost $940,000 in 09. And if we would have sold the business, Derek, in 09, we'd have owed the bank $2.5 million. Who cares about revenue? And so I'm sitting there going like, if 99% of the people are giving me a revenue answer, that means they have the wrong goal. So then how do you go back to the 5 principles, and we can unpack them if you want. But the question that kind of like all those things about the cabin, people would call me up and be like, Ryan, do you think I should hire that 2nd generation president, or should I hire a recruiter to hire someone from outside for 250 grand? Like, do you think I should launch that product or service? Should I buy that company? How much should I pay for that company? How much equity and how much debt? By the way, should I buy my company's building? Because now we've got the company growing. Should we spend $4 million to buy the building? I don't know, Derek. How am I supposed to know if I don't know what is the goal? And the goal, if we shift our mindset away from revenue, it's the same thing with real estate. These are assets. We're talking about equity prices and stock prices or net operating income, right? Cash. So with a business, it's what's the target equity valuation at a point in time. Then it synthesizes all those decisions. So the 5 principles, Derek, The reason I call it a framework is one is I will never tell anybody what to do. We're all adults, right? I'll never tell you what to do, Derek. But what I'll do is if you ask me a question, if you're soliciting my advice, I want to know what's your goal, with what type, and back to your 3 degrees of freedom. How close are you in these 3 degrees of freedom? What do we need to do with what timeline? What are the expectations? And then I can help you think through your trade-offs, but I'm not going to tell you what to do. You're grown up. So the 5 principles are used to synthesize, to bring context to that decision of the ones that I was listing off of: buy this, do that, hire this person, give them a framework of context to where they're at and their goal.
This is awesome. So is this something that people who are seeking the 3 degrees of freedom, let's say that there are people out there who are on their journey to try to build something up, and maybe they have something on the side, right? Like they're working a W-2 and they know that they're actively trying to build a business. And maybe most people who start off, when you start a business, it's many years of really hard, tough work. It's
Yes.
usually trial and error and trying to just make things happen and make things work. And luckily we don't have usually high stakes unless you inherit something like you did, right? Where you walked into a business and there's already a bunch of payroll and stuff already happening. What advice would you give to some people who are just starting out based on those principles that you mentioned inside of your framework? And then also, given the fact that people are trying to maximize their degrees of freedom, I know it's about context, but maybe is there general pointers that you could give for most people who are out there that are just getting started, right? Things to think about when it comes to the exit or when it comes to later on down the line.
For sure. And I think this will be a good spot where I'll just quickly give a quick overview of the 5 principles. There's so much material that's for free on the website that people can go dive further into, but the 5 principles, they go in order and they're a framework. Again, they're not telling people what to do, but it's synthesizing your choices through these. So the first one is, what is your vision? What do you want from your business and your life whole time? Essentially, that's tied to your freedom, Derek. What experience do you want for yourself in the business over time? Your legacy, your role, your community, all that stuff, your vision, the destination, the amenities, all that stuff. Second one is your financial targets. What are the financial targets that you need to hit to make the outcome worth it? So what is a target equity valuation and the cash flow you want on the way there? Then the third principle is your exit options. We boiled them down for companies, Derek, in 5 ways: internal transfers and buyouts, acquisition entrepreneurs, from my friend Walker Dybel that wrote the book, and then ESOPs, employee-owned companies, private equity firms, and strategics. Each one of them will impact your first 2 principles. So understanding your exit options and how they're going to impact your 3 degrees and your financials. And then the 4th principle is your grow value. Once you understand what your point B is, the grow values, now you have context of your plan. Use the context to figure out whether you should grow value and where you should make your investments in your company. And so that way, when you and I were joking about it's another reinvestment year, and don't blindly do that. Reinvest with a calculated return, like an institutional investor would. Everybody can do that. And then the 5th principle is your team of advisors, making sure that if you have the right team and you know where you're going, they can help you. So like Derek, I always joke around with the Google Maps analogy. Can you imagine hiring a travel agent and just refusing to tell them where you go? That's what most advisors do. It's like my CPA, the attorney, the M&A attorney, the banker, they're just making stuff up, man. And my dad and I didn't know where we wanted to go. So those are the 5 principles. And the goal is that any question, you can kind of synthesize them against those 5 principles to see if you're on track and your decision is tied to your goal. But the 3 big takeaways that you were asking for about these principles, about how to make them actionable for people, whether you're looking at having a passive investment, what kind of level of involvement should you, or what would be the results of these 5 principles? One is, what the heck do you want and why? We have to think through that. What do you want from your long-term career? We have 168 hours. If you're working 50 hours a week, what do you want to be doing? Who do you want to be talking to? What topics do you want to be talking about? And how does the business impact that? What do you want from the business and your overall life and why? The second one is, what is the target? And with your world, Derek, in real estate and business, we're both illiquid assets. And then you wrap around the stocks and bonds, your whole portfolio of business, maybe private equity or investing and business and real estate and all the other stuff. What's the target net worth and the illiquid assets that you want to have at what point in time? And specifically, actually, in the talk, I started off my answer with what's the target equity valuation, but the cash flow you want along the way there. Because if you think about it, if you bought an investment property and it needed a bunch of rehab, but you didn't have the cash to do the rehab, you'd have to slowly burn that cash and reinvest it. So you might not have any available income while you're building this net worth. So if your goal is to actually jump ship, like, make sure you have enough income while balancing the income to wealth, the equity creation. And then the third thing I would say is, what role do you want to evolve in? So that's more like if you actually planning on jumping ship from corporate America, how do you want your role to jump from corporate America? Maybe it's 6 to 12 months as the CEO or the maintenance and property management firm. But then you have a plan to get out of that and you don't jump and then get stuck like so many people do.
Yeah, that's great. I think that's really good advice for people to really think about, no matter where they are in their business. I think if you're starting or in the middle of it, or even planning an exit, I think that those are wonderful things to think about, because we are the CEOs of our own business in the business of life, aren't we?
Mm-hmm.
So, we are individuals that may be able to create multiple businesses or go all into one of them. And sometimes our life and our business kind of melds into a single entity where we
100%.
have to be in harmony with both of them. Now, and I love that advice that you've given to people out there, because I think it's really important questions to ask, and it complements the 3 degrees of freedom and informs the 3 degrees of freedom, or they inform each other. But what I wanted to ask you is on your point regarding mentors and your team of advisors, right? Everyone in business, regardless of whether you have your own business or you're looking to level up your game, even if you're in the corporate world, if you're working a W-2, I still think there's a place for mentors in everyone's life. You show me someone who is serious about something, and I'll show you someone who has a mentor, right?
Mm-hmm.
Has time blocked out in their schedule and has a mentor or a coach, right? So what I thought was super interesting as you were talking is sometimes mentors, they come at it from their own perspective. And us as the mentees, the people that are being mentored, we don't have the foresight to tell the mentors what our perspective is and what it is that we're trying to maximize. So I thought it was really awesome of you to say that sometimes we have to mentor our mentors in what it is that we want to maximize and what the context is based on, the previous conversation that we were talking about. So do you have any advice or any specific situations where that came up, where you had to actually sit down with the mentors and be like, look, I appreciate your advice, but we want to go in this direction, or here's the context, or how have those adjustments been? And maybe you've worked with other people where you've had to sit down with their mentors and their team of advisors and be like, look, XYZ, this person that you're mentoring doesn't want that, or it's not in alignment with what they really want. How often?
Dude, yeah, 100%, man. And actually you honed in on, Derek, a unique circumstance in the industry of advice that I actually found dysfunctional and I wanted to help fix, because when the experience that I had $20 million in revenue, man, we had a lot of pretty heavy hitting advisors come in, and I was part of Vistage. So my dad and I both were, I speak for Vistage now. So we were doing, in quotes for the listeners, doing all the right things, still flying blind. And what I think is, so how in God's name were these people supposed to help us if we didn't know what we wanted?
Yeah.
And this is so common. I have 365 podcast interviews where this is a common thing, and hundreds of keynotes where it's the goal is just this arbitrary revenue goal. Yet, so Derek, the podcast used to be called Life After Business for the first few years before I changed it to Intentional Growth. And this book Bo Burlingham wrote, Finish Big, is how many people were upset after they sold, even though they made so much money. It's because they didn't know who they were and what they wanted from their company and their job and their career and why. And when you take that away, they're like, I'm just no one. I'm Ryan that used to be this person. So what happens is the dysfunction comes from, if the advisors don't know what you want, an attorney, a CPA, a commercial banker, investment banker, insurance provider, you name any technical advisor, they're all left brain technical technicians, right? When a business owner, I have watched and assisted clients who will take way less money when they transition their company because they're financially free. We have a family friend that he sold his company to an ESOP, an employee-owned company, for $100 million. It was worth $190 million. This is a very dramatic example. I know I'm overboard with this, but I'm explaining he didn't need an extra $90 million. And by the way, he died 2 years after he did the deal. Yeah. So my point is, everybody would have advised him, Derek, to tell him to take the 190 because we are supposed to optimize for the highest number. He didn't want that. And we have to ask people what they want. And what I want for someone to say, like, if you had two offers, Derek, like if one's 5 million and one's 6 million, but you take the $5 million one, you could look at me in the face and say, here's exactly why I took that lower one, because they're doing this and this, and this is how they're treating my clients. It's kind of like, you don't want, if you sold your house to someone and your grandpa built your house and they're going to tear it down for a strip mall, but it's way more than the market value, you might say no. Yeah. It's your call.
Yeah. Yeah, absolutely. I love that analogy because it's all about what is important. It doesn't really matter if you're going to triple your money versus double it. If you have to go that extra 20%, that's 80% more effort, where your advisors would be happy if they're advising you to charge you for that time. And it's not important to you, right? And your advisor would tell you financially it makes sense. And you're saying it's going to take longer. It's going to be more of a pain in the butt. And yeah, I'll be financially, but it doesn't meet our goals. Like the goal is for me to have this nest egg so that when my kids go off to college.
It's the 3 degrees of freedom is the goal, man. Right. It's like, and actually just to double down on this point, we had this business owner that was working with us like, oh yeah, we think we might be doing this acquisition. And we're like, you told us you were planning on retiring in 3 to 5 years. It's like, if you buy this acquisition, you're going to be servicing that debt for 7, which means you, and they're like, oh yeah, I don't think I want to do that. It's just like, I mean, like, do you see, we didn't tell them what they wanted, or we didn't tell them what to do. We just said, you told us your goal was, this is contradicting your goal.
Yeah. To make a layer of more complication on top of this, Ryan, context changes. It's always evolving, right? So people's needs change, right? Like,
which is why it's a framework, Derek. So as time changes and the decisions change, it's not so prescriptive you can't evolve it.
I love that. Okay. So let's change gears from mentors. And I want to talk a little bit about growing business value. Now, obviously, growing business value is a common goal. I wanted to ask you how you think entrepreneurs out there can help think about creating a strategic plan to increase the value of their businesses. And I see here that there's functional areas of these value drivers that contribute to that growth, plug into it. And I just like your perspective on people out there that are trying to just increase the equity in their building, not in their building, but in their business. And I know right now that one way to do that is to take some income that you have and throw money back in. That's what you and I are both doing right now with our assets, right? Assets from the sense of it's our business. So it's,
yeah, no, that's the truth.
But I wanted to ask you, like, what do you see as a common thing where most business value grows that's maybe not so obvious, that maybe comes out of context, or anything that comes to mind?
This is why I love the analogy play between real estate and business, Derek. They're both assets. So what do we want in assets? We want more equity and we want cash flow. And the larger the cash flow and the more sustainable, predictable, transferable that future cash flow is, the more the equity of the asset is worth. So I'm going to start just to like level set with the audience on the real estate side, and then I'll transition over to business, Derek, and feel free to jump in and make sure that I'm course correct. But we have cap rates and net operating income in real estate, right? And the higher the cap rate, the riskier the asset, right? And I literally have a whole slide deck, Derek, when I'm talking about Principle 4 in my Vistage workshops or in the boot camp, where I pull up buildings because people are so familiar with it. And they like, it's like everybody understands, like the same building, this one's worth twice as much because it's fixed up, right? Everyone's like, yep. I'm like, well, business is the same way. And so when I think about this, an asset, like with real estate, if we don't have an anchor tenant, and I'm speaking of more like commercial real estate here, but if we don't have an anchor tenant, if we don't have annual, 5-year contracts, if it's in the slum, the asset value is going to be lower and the cap rate is going to be higher, right? Business is exactly the same, but we use different terminology. So what in business, it's called the weighted average cost of capital, the WACC. So then they call it the build-up methodology. So the higher the WACC, the more return we're going to need because the asset's risky. Like if Derek, you and I want to invest $1 million in a laundromat, you and I are just going to say, well, if we invest $1 million in a laundromat, how sustainable, predictable, transferable are those future cash flows, right?
Yeah.
And the less sustainable, predictable, and transferable, the more the return we're going to need for the risk we're taking,
Correct.
And therefore, the lower the valuation of the company. It's literally just like real estate. So what happens is in business, we take one divided by the WACC equals the multiple. So instead of talking about cap rate or NOI, we're just talking about this multiple. And it's just one divided by, so if you take like 20, it's 5. It's a 5 multiple. And the biggest thing in that buildup of risk, Derek, is the company's operational specific risk outside of industry. Like I'm acknowledging that, different industries have a different kind of asset class, but like all things equal, sorry if I'm listening, just to repeat for the audience, if I don't lose you, the weighted average cost of capital is very similar to the cap rate. It's the higher it is, the riskier the asset, which means the lower the value of the asset, the building or the company. We take 1 divided by, like, let's say it's 20, that's a 5 multiple. That's essentially, Derek, how many years of cash flow someone's willing to give that seller, all based on the risk of the cash flow, man. Mm-hmm. So just like, and so what we're trying to do with Principle 4 is hone in on, like within real estate, I always joke, or this is my joke, so you might not laugh, but whatever. It's like, I'm like, who wants to put a bathroom on the ceiling? No one's going to value it. And if it costs 30 grand to put a master bath in the ceiling, you're pissing the money away.
Yeah.
In business, there are exact analogies of if you invest in certain areas in your business, it's just like the fart in the windstorm. I don't know how else to put it. It just disappears. It's not like you had no reason to do that investment and there's no return. Because what we're trying to do with the investment of ERP systems, the right people, standard operating procedures, systems for marketing, for inventory, is the more data and the more systemized we have, which takes investments.
Yeah.
The more that multiple grows because we're reducing the weighted average cost of capital or the cap rate.
Yeah.
It's the same thing. Like if you would have a plan of how you're going to reinvest into the building and how you're going to use that cash and what your return would be expected.
I think it's beautiful. It's very similar to what we have in real estate. I'll give you an example for the audience of what this WACC or WACC reduction looks like in the form of cap rate, but also in WACC. Yeah, I guess also it's WACC. It could be this.
Isn't it so crazy how parallel it is?
Yeah, of course. And what we did one time was we had a one-time cost for utility company to go out and install individual meters on all of the units in the apartment building, right? That way, instead of having a flat rate, which is $30 a month or something for each individual tenant to just bill back, what we did was we looked at, okay, how much cash flow are we going to save each year if we install these meters? And we severely underestimated how much cash we were going to save, which was awesome.
Oh, nice. Yeah, I was going to say that's a good surprise.
Yeah, it was awesome because what we ended up doing was when we installed these things, yes, it cost us like $10,000 to have a plumber go out and install all of them. But what it did was it changed the amount of water that was being used, water and sewer at the property, because now these tenants had to pay directly for it. So it's not like they're paying $30 and they could use however much they wanted. So the behavioral psychology behind it changed it to a point where we were accounting for, $30 a month per unit, right? And we were saying, okay, how much are we going to spend to save that money, right? So that we can pass along all the costs to the tenants. Mm-hmm. But then it switched to, okay, how much money are we, like, it was explosive. It was really
awesome
because the consumption went down by a lot. And that really helps a lot because now, we don't have that cost anymore. And we easily like 4 or 5x our money in that first year just by doing it. If you're going to evaluate your building off of NOI.
Well, and the similarities are even more ridiculous too, because my guess is that was a one-time expense doing all of those installs.
Right.
Businesses are the same way. Like I paid almost 300 grand in executive recruiting fees, Derek, the year and a half before we sold, CFO, CIO, et cetera. You don't do that every year. Just like you said. So we actually pull that out of, it's called normalized EBITDA instead of NOI. Right. And it says that we're trying to get to the proxy for cash flow of getting rid of the one-time expenses. I mean, there's so many similarities and it's all about what will the future cash flows be?
Of course. Yeah. I love it. Fantastic. Okay. So we've talked a lot about business dynamics, looking at specific leverage points so that you can try to, reduce the WACC so that the value, or modify the WACC so that you can
You're right. Reduce your WACC. Yeah, WACC. Yep.
So let me talk about financials and organizing financials for the visibility. You mentioned this early in the show that without having a roadmap of where you're going, it's hard to know what plan to take. It's hard to know what to execute, right? Because if you don't know your metrics and you don't know your business, well, then what levers do you pull in order to try to make things work better?
Should I buy a cabin, Derek? Right? I don't know. Like, do you want one? Can you afford it?
That's right. So Can you talk a little bit about how companies can maybe look to structure their financials or their records to help get like a clear perspective on their trajectory to make more informed decisions? Because I know this is a common problem that runs across many people in many industries. I have since solved that problem, but I want to hear from you, how you've advised people to help like build a financial visibility type of framework for them.
So it all starts with trying to answer what I think are the common sense questions that entrepreneurs and business owners are trying to answer, which is, if I keep doing what I'm doing or I implement the strategies that I'm planning on, what will my cash position be in 12 months, along with my prepaid for taxes? And there's enough cash left in the business to fund the valuation target, not some arbitrary revenue target. Then what we can do is we can reverse engineer. And this is where I didn't make any of this stuff up. And this is why I really like what I do, because I watch all these consultants over my career, Derek, where they build their Venn diagrams or their pyramids, and then they want to die in that hill. Like, this is the way to do it. So the thing about this is, like, the monks invented double entry accounting in the 1400s. And the spreadsheet was either invented by Bill Gates and Paul Allen, or they stole it. Regardless, I had nothing to do with either of those things. So I was not there at the design phase. And so all I'll say is that what I used to do with our family business, even though it was 20 million, and I watch bigger companies and smaller companies make the same mistake, because founders are typically not accountants or Wall Street financial engineers. I was building pools, or I was an FDA consultant, or I was an HVAC technician, or I was a digital marketer, you name it. And probably a lot of people listening to this show who want to jump ship maybe from their corporate gig and not finance, just like me. And so what happens is people project out only the income statement. And what happens is, if you're familiar with the income statement or the P&L, you have the revenue categories that you make revenue on, and then you have your cost categories, and then you have your overhead categories, and then you've got your net income, or not EBITDA in my world, or net operating income. So what happens is, though, Derek, in the business world, I know this is very relevant in your world as well, but you can project out your income statement. But what happens is, if I project out straight line, whatever the assumptions are, even if I take seasonality into approach or into consideration over the future forecast, people raise their hand every single time. I'm like, hey, raise your hand if you ever had the issue of you're growing like gangbusters and you have no cash. Everyone's like, me. I'm like, or have you ever sat down with your CPA and the CPA is like, you did awesome, Derek. Yay. Your tax bill is 250 grand. And you're like, where's the cash?
Man, yeah.
So what I'm doing is I'm building up to, we're missing two parts of the story if we're just projecting out the income statement. So these three statements, the income statement, the balance sheet, and the cash flow statement, are all mathematically tied together. And that is what I believe creates this three-dimensional view into the future that I was never able to see to answer the questions that I mentioned, which is, what is my cash position going to be next year? In the middle of the year, not at the end of the year, in the middle. So if I want to know, should I buy the extra inventory? Should I hire that person? Can I take my distributions at the same time and fund my prepayment of taxes? If we can't see those trade-offs in clear view that are tied to our goal, we're making stuff up. And everybody just needs to say it, because like it has to be tied to a goal. And then when we have those trade-offs, if we don't, those answers are in the cash flow statement. So sorry, stop me from being geeky, man. But
you're good. I'm picking this all up, man. It's
so
good.
What I love about, like, so you have the income statement. And so people are like, this was this epiphany for me like 5 years ago, Derek. I was like, what? It was like the red pill in the matrix for me, man. It was a total experience. And I'm geeking out on finance. Again, copy your sales rep, D in accounting, just to remind everybody, is the income statement for my old business and a lot of the companies we work with. You sell something, a lot of times you have a receivable, because so we would sell things and we would invoice people, and then it took us 30 days to collect the money. If you don't do receivables, you might have deposits. You sell sunglasses online, someone gives you a deposit. So the receivable is on your balance sheet as a liability. The payables are on your balance sheet your receivables are on your balance sheet as an asset. Your payables are on your balance sheet as a liability. So your income statement interplays with your balance sheet like that, right? So you can't pay payroll with a receivable. And everybody that owns a company knows that. So it's important to monitor these things, because if you don't have enough cash, you can't make payroll. Back to my original $250,000 payroll issue that I had. So great. So now we've covered the interplay between the income statement and the balance sheet. Well, what's the cash position? What are my distributions? Do I have to put money back into the business? That's in the cash flow statement. Well, the cash flow statement is just a mathematical difference between the balance sheet over a period of time.
Right.
So if balance sheet from May 1 to June 1, did cash go up or down? Yeah. Receivables go up or down, payables up or down, inventory up and down. And then that'll give you your spot where you can see your distributions, your taxes, then cash position. And it all has to flow together, Derek. I say all that because we can reverse engineer the income statement from the goal. And then we can see how fast you have to grow. And if you run out of cash on the way, and if you do, fix it.
Yeah. So for those who don't have a CFO, right? Like there's a lot of these people that I know that are, buying single family homes, or maybe they're starting an Amazon, like an e-commerce business or something, right? And they don't have a CFO to help build all of this stuff. What would you recommend they turn to if they're looking for something like this, right? If they want to try to have some of this visibility, this live, profit and loss and balance sheet type reporting.
So there's a couple approaches that people can do it without doing a selfless plug, because I don't want to have someone be beholden to something that I built. But I would say that these are, we started with spreadsheets. It's double entry accounting, it's math. So you have to understand your business, you have to understand operations, and you have to understand math in a spreadsheet. And if you don't, and accounting. And if you don't, it's okay. I didn't either. I knew what I needed to see. That was the key component. And everybody, honestly, man, I'm so convinced that entrepreneurs and visionaries, then investors, they get that. So then it's having someone else do it for you in the manner I just said, because entrepreneurs can project out an income statement, and then you hand it over to your finance team and say, build out the cash flow and the balance sheet and tie it to the goal. So we have on our website a starter kit where I walk through people in a case study. They can see the case study for free. We'll make sure that you have the link. So I literally, Derek, show people and say, if you have a person you think is capable, have them watch that video and do that. That's why I do it in a spreadsheet, because it's literally I didn't invent it, and there's the video and it's a spreadsheet. So if they can't do that, then explore other options like an outsourced firm or a part-time person or something like that. And now there's even technology out there that we plug into people's accounting systems and stuff where it's a software dashboard. So, but I don't want to, people are capable of doing this on their own if you have the right people and you understand what you're trying to accomplish.
That's exactly what I wanted to hear, because I want people to understand that all of these things that we've been throwing out there are things that you can do. It sounds complicated, right? But if you really dig into it, just understanding the vocabulary from where Ryan is coming from is half the battle. And then you'll be able to understand how to put it into effect. And there's tons of tools and people out there that you can leverage, including Ryan himself. I'm sure he'd be happy to guide you. Now,
yeah. And the vocabulary, Derek, it doesn't have to be so confusing. And that's what bothered me about the finance industry and the service sector. It's they were talking to entrepreneurs. They don't understand this stuff.
Yeah, absolutely. 100%. So I wanted to ask you just a couple more questions, and then we'll get into our rapid round. Okay. But the first one is, we touched on this just briefly, but the business landscape is evolving, as it always does. Artificial intelligence is coming. It's more out there. It's starting to affect more than just accounting and some of the financial pieces. It's actually starting to become operations, including for mine as well. It's literally starting to get me to be either more efficient or hire less people. That's how impactful it is. How have you been seeing artificial intelligence starting to affect some of the businesses that you're consulting or your business itself?
I just did a 90-minute podcast on that a couple of weeks ago, and I am doing an event on this topic, and I will try and be succinct with it, with my response, because the opportunities are endless. And I'm not saying anything that anything I'm about to say is probably not novel, but what we're doing practically with our company and our clients, and kind of my thought about it, we can leave kind of the existential crisis of general intelligence alignment and all the ethical stuff for different conversations with different people. But for operations with the business, there are a couple of components that myself, our ecosystem, and our clients are focused on, Derek. One is kind of thinking about the bigger picture backwards. ITR Economics is there are these economists that are on my podcast once a quarter, and we talk about what's going on in the leading indicators of different industries, different sectors, what's going on with the federal fund rate, all these different things. And they have this, along with, I don't know if you're familiar with Ray Dalio. I'm a big, I've read the Changing World Order book 3 times this year already.
Yeah, he's really onto something there. I love it.
All right, so then for the listeners in there, if Derek's talked about it, this Prosperity in the Age of Decline book is these economists, and they talk. It's very much about the demographic cliff. So this has to do with AI. So what I'm getting at is there's going to be 80 million baby boomers, Derek, in diapers in 10 years, and nothing anybody can do about it. So what happens is we already are going into the slowest growth rate of the country and the world economy in a long time, because we're trying to get another jolt out of an athlete that's had 40,000 cortisone shots. And what happens is we need to keep growing. So I am watching this AI thing, and instead of having this doomsday of like, it's going to replace everybody's jobs.
Oh yeah.
My company is going to be able to 10X without 10Xing the people.
It's the,
and this is it.
That's
the hope. That's the hope. And what I think about this is interesting, Derek, is these people, the brain drain of every industry is happening. And so like our GDP is going to continue to go down. And if we need to do more with less, so I'm watching our clients, and the podcast that I did with this guy named Lauren, Open Model AI, where he's talking about privatizing AI. So based on these 8 functional areas in principle 4, like sales, marketing, ops, finance, how do we take these functional areas, enhance them, invest in things that de-risk the cash flow, right? Because again, going back to, if we de-risk that whack and de-risk the cash flow, we grow the value of the company. So we can have these functional areas where we have AI bots, or like essentially AI for marketing, for sales, for ops, for finance, that's helping the executive in that function.
Yeah.
Implement the strategies to de-risk the cash flow to essentially get where they want to go faster.
Yeah, I love that. And I love having executives, high-level executives, being able to turn dials, right? With AI. And that's essentially what it is. You turn dial, you tweak it, you split test it. And it's going to be a crazy world, Ryan, where we have people that are coming in, right? And we've got an AI bot on your end that's talking with the AI bot on the client's end. And it's insane what this world may come. But you're right. I think that this productivity comes down to how productive can we be in the United States. And the reason we got so competitive and had such a great competitive edge is that we were super productive throughout, the 50s, through the 80s, right? And we're just been kind of riding on all of that. Now,
and what's really fascinating, one last comment on this, is the definition of a prompt. Here's what's super fascinating that ties really into our overall concept of intentional growth. I can sit down, and I'll try not to make this long story, but like my partners did a whole private equity roll up. They bought 18 companies, 16 months, sold the whole thing, but for a lot of money. And they were spending like $5 million a month with EY on consultants and integration and all these things. You can sit down now in front of ChatGPT or other AI tools. If you know what question to ask, Derek, you can get the information. We built a strategic plan for one of our home remodeling clients in 8 minutes.
Yep.
That had a CFO or CEO strategic plan with a CFO strategic plan tied to the CEOs with a 13-week project plan. They're like, this is better than anything EY gave us. And it took us 7 minutes. And it's back to this. We knew what the goal was and what question to ask. So you can put me next to an EY kid that's 21 years old, that's charging $400 an hour, that doesn't know what question to ask. And we will beat him or her every single time because we know what question to ask.
That's awesome. Yeah, no, it's 100% true. After we're done with this call, I need to show you the power of prompts. And because I think, there's some
really just cause
it's really neat. Anyway, so we could go on talking about this forever, Ryan, and I really appreciate you coming on and sharing some of your wisdom with us. But I have the rapid round, which is 5 questions that are meant to be asked and answered in 30 seconds or less. So let's see if we can get through these quickly if you're up for it. And you ready to go?
Rock on.
All right. Number 1, name any resource that was or is essential in your journey to pursue your 3 degrees of freedom.
The Understanding of Money and Changing World Orders by Ray Dalio.
Yeah. Excellent place. Number 2, if you woke up and your business was gone, you had only $500, a laptop, place to live, and some food, what would you do first to rebuild?
I would start my podcast.
I love it. Great answer. And also very fulfilling to me. And also
the network, man. It's like,
we're doing right now. I love it.
yeah.
All right. Number 3, what does your self-reflection and goal setting practice look like?
Bullet journals. So I've been doing bullet journals for 7 years, analog, even though I'm a tech guy, analog bullet journaling, where it's annual planning, quarterly, monthly, weekly. And then it's the 3 wins every single night, 3 gratitudes every single morning, and then the 3 wins. And it's just this constant refining of making sure that I'm not off track.
I love it, man. Fantastic. Number 4, what are the core work habits that you attribute most to your success?
Curiosity. Curiosity and the pursuit of truth.
Yeah.
I don't know what else to say.
No,
Yeah.
that's great, man. Like those things account for a whole lot of success in many people that I've talked to already. Curiosity is the main thing because you approach things from a healthy detachment, but yet wanting to be hungry for knowledge. And I can tell.
And then you don't want to stop if it's not true. Because if the logic doesn't make any sense, I'm not going to stop.
Of course. You want to be like, why is this still here?
Yeah. Why?
All right. Last question I have for you, because we talk about time freedom as well, which is about systems and VAs and, getting all of that in order for you. What tool or process has become one of your most important time, money, or energy saving ninja magic tricks that you use almost every day?
Because of my personal productivity system that I've built, I've evolved it over time to make it work for me over 7 years. But I introduced this year, Derek, which is the Superhuman email tool. I didn't actually go with the Superhuman, but the split inboxes that they were talking about. So I'm actually onboarding my executive assistant that I've wanted for a long time. So the split inbox deal is I've categorized my work types, like clients, marketing, podcasts, content to consume. So everything that hits my inbox, I immediately drag them over into these split folders. And then I schedule time when I'm going to do those. So I don't get anxiety every single time I pull up Outlook anymore.
We have a little bit more to talk about after this podcast. So we'll talk after this. Anyway, Ryan, it has been a pleasure having you on, and really enjoy the fortuitous meeting that we had, right? For your assistant reaching out and, us being able to connect in this way. I wanted to ask you though, if people out there in the audience who are listening now want to reach out to you and find out more about what's going on in your world, how could they do that?
I'll make it really simple. Arkona, ARKONA.io is the website. The podcast is there. The meeting link to schedule a meeting if you're interested. Our online academy, that starter kit that I mentioned. Honestly, Derek, I'm the chief revenue officer. People can call my cell phone, 612-720-6530. And that podcast I did when I told you that there was 80,000 people on, the guy gave my podcast or my email or my phone number out. You can't even make it up, man. So I was like, hey, what the heck? I'd never done it before. So there you go.
That's awesome. Well, Ryan, I appreciate you, man. Thank you so much. And for those who have been listening, please do check out Ryan's website. There's tons of information there. His framework is right there on the homepage. I just checked it out when I first got booked with Ryan here. And there's tons of other great information out there. He's got a podcast. Go check that out. Tons of stuff that you can learn from him. And Ryan, all the links that you provided for social media and everything will also be put in the show notes for this episode. So
awesome.
Ryan, thank you so much for coming on the show.
Derek, this has been awesome, man. I really enjoyed myself.
It's been fun. And for you listeners, we hope that you've been sharing in on the fun as well. So wherever you are listening or watching this podcast, please make sure that you like, subscribe, comment, just engage with us in general so that we can appease those algorithm gods and they can help get us more exposure to more great people like Ryan to come on the show as a guest, or more listeners like you so that they can listen into some of our awesome conversations. So thank you, listener. And thank you, Ryan, again, for coming on the show.
Thanks, Derek.
See you guys next week.